later. Now we come to the stop order. As we discussed, will the stop order always be above or below the price? It will always be ahead of the price, because when the price moves in that direction, as we discussed earlier, then we enter.
We will do it. Now we come to it. We have learned the entry. Now what are the ways to exit? For example, I have opened the position. Now I have to close that position. Now how do I protect that position? Against my intention. We shall enter a trade with the intention that we will make a profit. But if the trade goes against you most of the time, for what you have to do, we have two types of orders. One is a stop loss order and the other is trading stop loss. What is a stop loss order? For example, whenever I opened an order, whether it was a market order or a pending order, in pending it was a limit or stop order. Now I have set its stop loss so that if the price goes beyond this exact area, I will incur a loss. I will accept my loss and my position will close. But what is a trailing stop? A trailing stop is when, for example, you have set a trailing stop at 10 pips. When does the trailing stop activate? When the price moves in your intended direction, whether you have placed a buy or a sell, when the price starts moving in the direction you want, what should you do? If you set a trailing stop, for example, when the price reaches 10 pips profit, your trailing stop will activate. Now, if the price goes to 20 pips profit, the stop loss difference will remain 10 pips. That means the price is moving in your intended direction, so trailing stop. Someone is told that it follows behind. So as much as the price moves forward, it will move back by 10 pips. So whenever the price comes back by 10 pips, your stop loss will be hit. And if, for example, the price comes back 10 pips, as soon as your stop loss is activated, you will incur a loss at your entry price. Your position will close at break even. What is the advantage of a limit order? It enters only when the price comes back. What is a stop order? It activates when your price goes up. So what is the difference between the two?
The advantage of a limit order is that it gives you a better price.
And what is the advantage of a stop order? It does not give you a good price, but if you are successful in your expectation of a breakout, it gives you more pips. Then, apart from these main orders, there are also some other orders found in Forex that we place. One such order is GTC, good till cancelled. This is an order type within an order type. For example, we have set a buy limit or sell limit. We have the option to choose the GTC option, meaning until I cancel this order, the buy limit or buy stop or sell limit or sell stop will remain active. Whenever the price after 1 month or 1 year reaches there, this order will be activated. So what is its alternate option? GFT, which we call good for so day, means if by the end of this day this order is triggered, this price will expire and be triggered. If this order is not triggered by the end of the day, it will automatically be cancelled. We call that order type sub-order type. Good for the day, meaning GFT, then we learned GTC, good till cancelled, then GFT, then we learned, and then after that OCO. Now for example, I placed a buy and also set a buy stop. So here I have also set a stop. There is news, an event, or the market is in a range, stuck in consolidation. My expectation is if it goes up, it will keep going upside. If it goes down, it will keep going on the downside. So I have set buy stop and sell stop on both sides, and I have added a condition to it. Added the suborder type called OCO, which means one cancels the other. When one is triggered, the other will be automatically cancelled. If I place the sell stop on both, the sell stop gets activated. The buy stop will automatically be cancelled. If the buy stop gets activated automatically, the sell stop will be cancelled. We call that suborder type OCO, one cancels the other. Then we have OTO, one triggers, direct trigger the other means that the second order, for example, if I am layering or stacking, I have opened multiple positions, so if one position is activated, then the other position will be activated. Otherwise, it will not be activated. We call it OTO. We have another thing which we call sales stop limit. Now, what is sales stop limit? We have two prices. Now, our previous price will be hit, then the price will come back. For example, we are saying the price is at USGP 150. Now, I have set a sales stop limit that when the price touches 148, breaks out and comes back in a week, I will sell from there. That will become the sales stop limit. Secondly, we have an order type called buy stop limit. For example, I have it at USGP 150. I have to buy from there. Now my price will break. It will go to 152. I have set a stop, set a limit at 152 when it goes to 152 and comes back to 150. After confirmation, my buy order will automatically open. And if it does not go up to 152 and comes back to 150 from 151.9, my order will not be triggered. So all our order types are complete. This was one order left, which I have discussed with you. Advantages of the market. Do market orders get passed? They execute quickly. Execution is, though there is a high probability the order will fail. What is the side effect of a market order? If there is a news event happening or the market is moving very fast, the difference of microseconds or milliseconds between pressing the order button and its execution will occur. It affects the price. Sometimes it becomes 10 or 20. We call it slippage in another language. So slippage 2. The chances of this in market execution order type in a fast-moving market are very high. Now, what is the advantage of a limit order? A limit order will only execute when the price reaches your area and there is no space. But the issue with this is that the price may never return and your execution is not guaranteed. However, whenever execution happens, it will be at the exact price. But for this, you will need a lot of patience. Next, stop order. Stop orders, exactly like market orders, have a very high risk of slippage. In this ICAT, you have no control over the execution price or final price. Because when the market is moving in a fast direction, by the time your order is triggered and pressed, demand has gone into the market and supply has occurred. The difference that arises is shown in the order. Now, this difference does not occur in limit orders, so limit orders are safe. Stop orders in very volatile, fast-moving markets can be very dangerous. Has decreased. GFD, OCO, and what are all these order types? Meaning, we can categorize these independent order types. For example, we said that a buy stop is GTC, good till cancelled. Until I close it, it won't close, but by changing its category, I will make it GFD. Then it will become good for the day. That today, when the day expires, it will automatically be. After this time, the order will be cancelled. Similarly, OCU is also like this. We added the condition that it will automatically cancel from 2 stops, as I discussed earlier. These are all their advantages and disadvantages. These are all order types. These main order types are used to further edit them. These are such theses, such orders that are correct. Such orders are never used. This is always with any buy limit, buy stop, sell limit, sell stop. Now next we come to our Forex trading session.